Welcome to TheStreet.com TV. I'm Aaron Task here at the offices of Smart Financial Partners with Joe Capone. He's a founding member of the firm and a contributor to RealMoney.com. Joe, great to see you again.
Good to be here.
So your most recent article for Real Money is about a stock I wouldn't think of you writing about because it's not a pure financial, but GE and the rationale for breaking up GE. Why would it make sense to break up GE?
Well, really, if you look at the environment right now in the investing world, I mean, there is a trend to break up the conglomerates. And Jeff Sprague of Citigroup put out a report April 27th suggesting that a sum of the parts valuation would give a $45 value for GE. It was trading at the time at $35. The company also has a 3% dividend yield. I'm familiar with one of the components of GE Money.
Right, because you're a financial guy. Right, okay, so let's talk about what is GE Money worth in your estimation?
I think GE Money per GE share is worth around $6.50 in total, which would be roughly a 16 to 16.5 PE if it were separated from General Electric. This is a great company. 75% of its earnings come from outside the US. It's doing great work in the emerging markets, particularly in Central and Eastern Europe. And in the first quarter, as an example, even though it's also one of the major US subprime mortgage players with WMC, still posted a year-over-year increase in net income, and that is inclusive of all the charges.
Right. And you say maybe in your piece, maybe not because of the subprime space, but for the other assets it has, it's most comparable to American Express in terms of publicly traded companies that are out there now?
I think so. I think American Express is also a great company with a global brand, and if you're to look, it's hard to benchmark. You know, when you have a reader actually had emailed me today saying, well, you know, how do you know to compare GE Money to American Express? Maybe AIG is more appropriate. Right. But no, I actually think American Express is right. These are both companies with revenue growth, with great brands globally, and you know, and good organic growth. In addition to having some pretty good opportunities down the road.
Okay, so you're valuing $6.50 a share for GE Money, $4 a share for GE Real Estate. Mm-hmm. And then the NBC unit at $4 a share, and that comes coming from Sprague, the city analyst. In terms of the NBC unit, Barry Ritholtz actually posted something on Real Money yesterday about how that they should do everything they can to prevent Rupert Murdoch from getting Dow Jones. Maybe they should buy Dow Jones to sort of bring that in to make NBC stronger, make CNBC stronger, and then spin out NBC Universal as part of that deal. Do you see GE at all making inroads or trying to step in and stymie that deal?
With the preliminary caveat that I'm not a media analyst, I'll try to answer this as well as I can. First and foremost, we should say that Jeff Immelt publicly said today he was not interested in bidding for Dow Jones. So, but that's still, we should talk about the potential incursion of News Corp into Dow Jones and how that would impact CNBC, which is a great marquee property for General Electric. I think first you have to understand Fox Business Channel is going to get launched next year. CNBC and Dow Jones have a content sharing agreement through 2012.
Right, they provide people to go on the air, they provide stories, they're sort of like the newswire service for CNBC.
Exactly, but post 2012 there would be some concerns that maybe the content sharing agreement will now be with the new Fox Business Channel. So yes, I think GE should be somewhat concerned. It wouldn't shock me, and I do not have the content sharing agreement. Perhaps Jim Cramer does somewhere, but I don't have that sharing agreement. I would think that we could see that deal being renegotiated somewhat, because obviously CNBC is going to want to have some access to Wall Street Journal reporters. You may also see, and this is completely speculative, but I would assume CNBC is going to also look to the Financial Times, which also breaks a lot of stories during the day. They have a good history of that. New York Times, Reuters. I mean, CNBC is going to look elsewhere, but no, it was a concern, and Barry Ritholtz is correct, and I think some other people, Doug Cass and Street Insight, another sister site of TheStreet.com, had said maybe GE would overpay for Dow Jones, but it appears from the top, Jeff Immelt, they're not going to be doing that.
All right, so while we're on the subject of the top, Jeff Immelt, I don't imagine that he waited that long to become CEO for Jack Welch stepped down. He battled his way to the top to be the guy who breaks up GE. What do you think he would think about Sprague's analysis and your analysis that he should break up the company?
Well, I think, and this cuts back to some other investments we've talked about in the past few weeks, I think the good thing for investors is you don't have to be right on there being a breakup. What you need to do is to get in front of the big institutions. They're like battleships trying to turn around in the Hudson River, which for those of you who don't know New York, that would be hard to do. It's only a couple miles wide. So
at its widest point.
Right, it's hard to do. All you have to do is get in front of the institutions. If they see that this is worth $45 or more if you sum up the parts, they may think $35, $36 is too much of a discount for it to trade even if it isn't broken up. And there are some synergies with these businesses anyway.
Right.
You could see a spin-off of NBC Universal, I believe, probably next year or in 2009. But I just think as investors re-examine what hasn't moved this decade, and GE largely hasn't moved, I think you're going to see some of the big institutions say, you know what, let's move from an underweight to an equal weight or an overweight in this stock. And I think that can move the shares by a few points. Let's get in front of it as smaller institutions and individuals.
Okay, and you're long the stock in part based on that expectation?
Bought it on the opening when this report was published. The stock has done, it's already up a couple of points since then, and I think it has a few more points left in it, easily.
All right, Joe, thanks very much.
Good to be here.
For Joe Capone of Smart Financial Partners, I'm Aaron Task. Stay tuned for more of TheStreet.com TV.